Let's talk about the data supply chains and how to integrate the different kinds of data and find greater consistency across our enterprise. Data warehousing kind of grew up because we couldn't get the reports that we wanted to have, and when we got the reports, we couldn't ask the why question. Why do we end up with that number? Because our financial systems were by and large created to highly aggregate the data quickly. And once you highly aggregate the data, you can get to the answer of what is the answer, but you can't answer the question of why is that the answer, because the detail's gone. Our data supply chain takes business events and produces an analytical output. And the analytical outputs, obviously, for each data supply chain are different, but the inputs are very consistent. They're the business events, they're the transactions. A story is told of a senior executive of a major firm coming in on day one and meeting with a local business head for one of the divisions. The new executive said, let's look over these numbers here that we've accumulated and talk about the performance of the division. The business head said, well, let me show you these numbers. The new executive turned to the nearby CFO and said, do you recognize these numbers? And the CFO said, no, those aren't our numbers. And the new executive CEO said, well, then I guess this meeting is done. Right there were two different data supply chains that produced two different set of numbers. Which ones are right? The transactions at the customer side aren't all the transactions there are. Do you think that you can, from the data warehouse, if you copied all the transactions from all of the source systems, can you go create the financial statement? The business events get transformed, particularly in the finance process, into other kinds of accounting events. Finance has perspectives that are local for management reporting, that are regulatory, product control, regional in nature. A data warehouse typically uses an ETL process, a single record in, single transaction out. If it's an old organization, large organization, it has the specialized ETL processes called accounting rules engines embedded all over the place. An accounting rules engine takes a transaction in and it outputs at least two events, a debit and a credit. For a major financial services firm, it actually can be a single transaction in, and it can be 16 transactions out. They might put out 16 different things because you might have to reflect regulatory impacts or reserves or taxes or all these other kinds of things that aren't really customer, but they're enterprise needs. Let's make these points a bit more visual by reviewing in detail some accounting rules engine with some sample data. When talking about financial reporting and data, let's consider where the data is created in the daily financial cycle of financial services firms. The day is filled with transaction processing, capturing business events from customers and turning them into transactions. The night is filled with preparing that data and organizing that data to begin the cycle again the next day. There are two major phases broken up into four different parts in the nightly process. The first part of the night is taken up with detailed customer posting, detailed transaction processing and organization for the next day. The second part deals with the enterprise views in the general ledger. Detailed customer posting takes transactions and updates the customer balance. This makes the next day more efficient because all of the transactions don't need to be dealt with. All of the impact of those transactions are captured within the balances. These transactions and balances are often transferred to a data warehouse in order to provide some level of reporting. Financial reporting requires clean cutoff as of certain periods in time. The income statement shows activity over periods of time. The balance sheet shows position as of a point in time. The time periods involved could be minutes. Someone could produce income statements for every minute and a balance sheet at the end of each minute, but that's excessive. Typically, the smallest meaningful unit is to do something within a daily financial cycle. This cutoff is important for all financial reporting, regardless of the firm, regardless of the process. Knowing when you're reporting as of is important for all analytical processes. The difference between data reflected in balances and that reflected in transactions should be clear to almost anyone that has a banking account. Transaction reflects the activity, whereas the balance reflects the status as of any point in time. Anyone that would have deposited money within one day and written checks or made payments out of that account within the same day would know that the balance may not reflect the high and the low of the account, whereas the transactions reflect both. In financial reporting, we have to show the activity. Balances are not adequate for financial reporting purposes. Let's drill into these transactions and understand a bit more about how they're calculated and what their impact is on financial reporting. Let's use as an example a customer purchases some securities on margin. This might be the transaction that might be made in the source system for the security purchase. $100,000 worth of securities with a global scope and the customer perspective reflected in the transaction. The second business event is that the purchase is done on margin. In other words, a loan is given in order to purchase these securities. These two transactions don't represent everything that's happened with the customer, though. There are likely other transactions that are generated in the source system, likely using these as the source to calculate what those amounts are. For example, local taxes due are likely calculated based upon the security purchase agreement amount, rather than something independent. This transaction is very important as well for financial reporting. And similarly, commission expense is also calculated based upon the security agreement. Note, though, that all four of these transactions are agreed with the customer, are shown to the customer, are from the customer perspective rather than the enterprise perspective. Additional transactions are created which represent the enterprise perspective, not a customer perspective. For example, loan loss reserves calculated off of the margin loan are also calculated, those at the global level and those reflecting the local loss reserve. The local loss reserve might be calculated based upon a different standard than IFRS or GAAP for the enterprise, and thus a separate transaction may be required for those. And so, in summary, even in the source system, there is a relationship between certain types of transactions, those that are primary transactions and those that are dependent transactions, based upon the originating values in the originating business events. These dependent transactions may not be calculated at the same time as the original entries, and they may not be recorded or calculated even in the same source system. They can be recorded in numerous different places, but getting to a perspective for financial reporting for the enterprise, all of these transactions are necessary. These transactions all might be generated in the source system, or they might be generated in related systems that are all part of this general processing cycle at this detailed customer time of night. Finding the full sets of these transactions and the relationship between them is not an easy thing to do, but it is something the regulators are requiring us to do because the clarity that comes in financial reporting from understanding the full set. Let's go back to the high level and consider the next major process in the evening, the general ledger journal creation. Once the transactions have all been generated and updated the customer balances, we're ready to move on to the enterprise perspective by creating journal entries. Because the majority of the time available for organizing and preparing the data for the next day's processing is taken up with detailed customer posting, the enterprise perspective must be processed much more quickly with much less computing capacity. This means that often the general ledger postings are done in aggregate. The day's transactions are typically aggregated to create a journal entry of some sort. The change in the balances is typically also captured in order to provide a control that the total activity passed to the general ledger is correctly reflected in the balances. For example, these customer transactions, along with all these other customer transactions, at the end of the day are accumulated to create aggregated journal entries that are then posted to the general ledger. Processes which create these transactions are called accounting rules engine, whether they're created in detail or in summary, and any place they're created within the organization. The use of these aggregated entries is not necessarily a problem for accuracy. They're highly accurate and they're highly audited. It's been used for a very long time. The problem comes when we try to reverse the flow, drilling down from these aggregated balances to find the detail behind them. It's nearly impossible to do in most systems. Our approach to solving this problem has been to add another repository to contain all of these transactions and balances in order to have them at least contained in one place. So frequently, we copy all of the transactions to the data warehouse from any location that they came from and build up the data warehouse so it has all of this data. The problem comes that even though the data is now in one location, the linkages between the data is not clear because those linkages weren't maintained when the data was created. When one considers just one single report required of banking institutions, of FR 252A Complex Institution Liquidity Monitoring Report, all of the different aggregations required, all of the different perspectives that are required are very difficult to produce in a consistent manner with consistent data, because of this complexity of how the data is created and the linkage is lost throughout the data supply chain with every organization. The solution to this problem is to start by finding the data underlying the general ledger entries. The general ledger has to be right. It's untenable for the organization for it to be wrong. It is the cornerstone of all financial reporting, and starting with the balances and transactions or journal entries in the general ledger is the place to solve this problem. General ledger posting journal entries are like a compass pointing north for your process of finding the transactions and locating the accounting rules engine throughout your organization. Begin by finding these balances for some period of time and tracing backwards, locating the underlying detail behind those journal entries. Some detail may be still aggregated because it's produced and created in aggregate. Others you can find the individual business events for. Making sure that you know what those business events are and the process by which they were created, either in aggregate or in detail, is key to solving this problem. Once this is known, then you have to decide how you are going to retain the linkages between these individual detail events and the aggregated postings used in financial reporting. Then these sets of transactions can be copied with the linkages into the data warehouse to begin building a basis by which financial reporting can be done in a consistent way across all levels of detail. Accounting rules engines are a key piece of any financial system. So if you were to look, though, across an enterprise and try to get to some level of consistency, how would we go after that? Well, if you lowered the detail maintained in the accounting rules engines, if you did do things closer to the customer contract level for taxes, reserves, and those kinds of things, if you start narrowing down all of those different perspectives and you get to a common set of what's the intersection between these data supply chains, you start to end up at the notional contract balance for customer contracts in financial services. Those are the things that you need to maintain step-ups around. The concept of a step-up is a peculiar kind of balance in that it is an accumulation of a lot of transactions, and it's an accumulation for a specific purpose. But then that balance, that step-up, can be used to add together with other perspectives to get to a greater perspective that's needed. For example, if we made our books of record start with a customer perspective, the customer, whatever we agree with the customer, whatever's going to go on the statement, that's the first thing that goes in the first balance that we create in the financial platform. Then, if we have other things that then that we don't reflect to the customer, but they're an enterprise perspective, if I want a perspective that gets me the 10th item, and all of those other items before it were part of that, then I take all of the balances up to balance number 10, and that gives me my total perspective. If I want only perspective number 5, I only take the first 5 balances and add those together. Doing that, I haven't ever duplicated those transactions in other balances. They're only stored in one place. They're stored in one step-up location. But simply maintaining the linkages when some of the transactions are generated in aggregate is not adequate for solving the total financial systems problems. New processes need to be developed somewhere in the data supply chain which replace those aggregated transactions generated with detailed transactions at the customer contract level. This will increase the accuracy and aggregations that are presented in so many different reporting processes. The last piece of the problem, though, is to consider the reporting process. Detailed data has been increased in the data warehouse. Aggregated entries have now been generated at a more detailed level to facilitate aggregations again in the different cuts of the reports that are required. The process of aggregating all this detailed data into the required reports can be very time or resource intensive. The issue is we're not producing one aggregated report from that detail, we're producing many aggregated reports. That was the purpose in creating those details. The other problem is that over time, the details in the data warehouse accumulate because financial reporting doesn't deal with the business events, it deals with balances, typically over periods of time that require large accumulations of data. This issue of many reports and a lot of data to produce those reports means that we can't economically do it with computing capacity. A key concept that can be used here is to produce something called step-up balances. Step-up balances eliminate the volume problems of using transactions. Let's use as an example the loan loss reserve balances that need to be calculated for both a global perspective and locally. Suppose that the local reserve is calculated based upon IFRS rules plus some delta or change off of that. If the balances are calculated and maintained separately, when it comes time to calculate the local net balance versus the IFRS net balance, they must be calculated independently. This isn't a problem unless an adjustment comes through that changes the IFRS balance, in which case the adjustment will either have to be duplicated for the local balance or it will have to be applied both to the IFRS balance and the local reserve. This creates reconciliation issues because now the IFRS balance is represented in both the local and the IFRS reserve, increasing the difficulty of reconciliation and increasing the risk of errors. If instead step-up balances were used, then the IFRS portion would only be kept within the IFRS balance. When the adjustment comes through for IFRS change in regulation, it's only applied to the IFRS balance. At report time, when needing to calculate the IFRS net loan balance, only the IFRS reserve is selected. But if needing to calculate the net local balance, both IFRS and the local reserve are both selected. This process of using step-up balances reduces the number of transactions needed to produce reports, reduces the amount of reconciliation between balances, increases the accuracy of the reporting processes and the repositories and the resulting reports. Doing so will allow the organization to begin undoing layers of processes which accomplish the same thing in different means in different places through different technologies, and begin to build up a data environment that is consistent and helpful and ultimately will be lower cost to everyone involved. Those kinds of aspects will help simplify the data supply chains and consolidate data supply chains, reducing reconciliation, answering more questions, providing longer life to the systems. We'd have much more flexible reporting systems, much less reconciliation, much greater data integration, and we'd have more power behind our analytics because people would hear the numbers and entrust them and would act upon the measurements we've made.